I analyzed the actual portfolios of over 100 millionaires, not what they say they invest in, not financial advice they give publicly, their real holdings. And what I found shocked me. Everything I thought I knew about how rich people invest was wrong. They don't diversify into hundreds of stocks, they don't constantly rebalance, and most surprising of all, they barely own any bonds. There are three things that showed up in almost every single millionaire portfolio I looked at. And if you're not doing these three things, you're investing like a broke person, not like a millionaire. Let me show you what I found. Before I reveal the three patterns, let me tell you how I did this research. I analyzed data from the 2025 long-angle high net worth asset allocation study. This study looked at real portfolios from high net worth individuals with investable assets ranging from $1 million to over $30 million. These aren't celebrities. They're not lottery winners. These are self-made millionaires who built wealth through decades of smart investing. The study tracked their actual holdings, what percentage they put in stocks, real estate, bonds, alternatives, and cash, how long they held investments, what they avoided, what they concentrated in. And here's what matters. These patterns were consistent. It wasn't one or two outliers doing weird things. It was the vast majority of millionaires following the same three principles. So if you want to build wealth like a millionaire, pay attention, because what I'm about to show you goes against everything most financial advisors will tell you. Let's start with thing number one. Thing number one, millionaires don't over-diversify. They keep their portfolios shockingly simple. Here's what conventional wisdom says. Diversify into hundreds of stocks across dozens of sectors in multiple countries. Never let a single investment be more than 5% of your portfolio. That sounds smart, right? Spread your risk. Don't put all your eggs in one basket. But here's what millionaires actually do. The average millionaire portfolio holds just 7 to 12 positions, not 100 stocks, not 50 ETFs, 7 to 12 concentrated holdings. Even more surprising, 34% of millionaires had a single position representing over 40% of their net worth. Let that sink in. One investment, 40% of their wealth. Now, here's what this actually looks like in practice. According to the long-angle study, the average high net worth portfolio breaks down like this: 47% in public equities. That's stocks, index funds, ETFs. 15% in private companies. These are businesses they own or have equity in. 17% in real estate. 8% in alternative investments like commodities, art, or private equity. 8% in cash. And here's the kicker: only 5% in bonds. So what does this mean? It means millionaires aren't spreading their money across 200 different investments. They're putting big chunks into a small number of things they actually understand and believe in. Warren Buffett has a quote about this. Diversification is protection against ignorance. It makes very little sense for those who know what they're doing. Now, before you think this means you should throw all your money into one stock, let me be clear. These millionaires aren't gambling. They're concentrating in areas where they have knowledge, expertise, or conviction. If you work in tech and understand the industry, maybe you own more tech stocks. If you're in real estate, maybe that's where you concentrate. The key insight: you can't know everything about everything. So millionaires pick a few things they actually understand deeply and put significant money there instead of owning a little bit of everything. This is the opposite of what most beginner investors do. They buy 50 different stocks because someone told them to diversify, but they don't understand any of them. Millionaires would rather own 10 things they deeply understand than 100 things they know nothing about. Thing number two, millionaires hold their investments for an absurdly long time. Most people think rich people are constantly buying and selling, timing the market, finding the next hot stock. Wrong. Here's the data. 97% of millionaires made their wealth through boring, consistent, long-term holding. The average holding period for their winning positions, 15.7 years. Not 15 weeks, not 15 months, over 15 years. Let me give you a real-world comparison. Let's say two people start investing at the same time with the same amount of money in the same S&P 500 index fund. Person A checks their portfolio constantly. When they see a 10% gain, they sell and try to find the next winner. They're always moving money around. Person B buys and literally doesn't look at it for 15 years. After 15 years, Person A's constant trading, fees, and taxes leave them with significantly less wealth than Person B, who did nothing. The pattern is clear. Less trading equals more wealth. Warren Buffett's favorite holding period? Forever. He's owned Coca-Cola stock since 1988. That's 37 years and counting. Here's why this works. When you hold investments long-term, three things happen. 1. You avoid short-term capital gains taxes. If you sell an investment within a year, you pay your regular income tax rate on the gains, which can be 22%, 24%, even 37%. But if you hold for over a year, you pay long-term capital gains rates, which max out at 20%. That's a massive difference. 2. You let compound interest do its magic. Every year your investment grows, the next year's growth is calculated on a bigger number. That compounding effect is insanely powerful over decades, but barely noticeable over months. 3. You avoid emotional mistakes. Most people sell at the worst possible time, when the market crashes and they panic. By committing to hold forever, you remove emotion from the equation. Now, here's what this looks like in millionaire portfolios. They're not checking their stocks every day. They're not reacting to news headlines. They're not selling when things dip 10%. They buy quality assets and hold them through recessions, market crashes, and volatility. If the market drops 20%, they don't panic sell. They either hold or buy more. This is the hardest thing for most investors to do, but it's also the most important. Thing number 3, millionaires barely own any bonds. This one surprised me the most because it goes completely against traditional financial advice. Financial advisors love to recommend the 60-40 portfolio, 60% stocks, 40% bonds. The idea is that bonds are safe, stable, and balance out stock market volatility. But here's what millionaires actually do. Even conservative millionaire investors hold less than 10% in bonds. The average, just 5%. That means 95% of their money is not in bonds. Why? Because bonds don't build wealth. They preserve wealth. Let me explain the difference. Bonds are loans. When you buy a bond, you're lending money to a government or corporation, and they pay you interest. Right now, a 10-year U.S. Treasury bond pays around 4% per year. That sounds okay until you realize inflation is running at 3% to 4%. So after inflation, you're barely breaking even. Maybe earning 0% to 1% real return. Compare that to stocks. The S&P 500 has averaged 10% annual returns over the last century. After inflation, that's about 7% real returns. Millionaires understand this. Bonds don't make you wealthy. Stocks, real estate, and businesses make you wealthy. Now, does this mean millionaires have zero bonds? No. Some hold a small percentage for stability or liquidity, but it's not the core of their portfolio. Instead, here's what they do with the money that would traditionally go into bonds. They keep it in cash for opportunities. According to the study, millionaires hold about 8% in cash. Why? Because when a great investment opportunity comes along, a market crash, a business deal, a real estate opportunity, they have liquid cash ready to deploy immediately. Cash gives them optionality. They're not locked into low-returning bonds. They have flexibility to act when opportunities arise. This is a key mindset shift. Poor people see cash as sitting on the sidelines doing nothing. Millionaires see cash as loaded and ready to strike when the opportunity is right. So the third pattern, millionaires don't rely on bonds for safety. They use stocks for growth, real estate for income and appreciation, and cash for opportunities. All right, so now you know the three things millionaires do. They keep their portfolios simple and concentrated, they hold forever, and they ignore bonds. But what does this actually mean for you? First, let me be clear about what this does not mean. This does not mean you should put all your money into one stock and hope for the best. These millionaires are concentrating in areas where they have knowledge and conviction. You should do the same. This does not mean you should never sell anything. If a company fundamentally changes or your investment thesis breaks, selling makes sense. But you shouldn't be trading constantly. And this does not mean bonds are evil. If you're retired and need stable income, bonds have a place. But if you're building wealth, they probably shouldn't be a huge part of your portfolio. Here's what this does mean. If you're in your 20s, 30s, or 40s and trying to build wealth, your portfolio should probably be 80% to 100% in stocks, real estate, or businesses, not bonds. Instead of trying to own 100 different stocks, focus on 5 to 10 quality investments you actually understand. Maybe that's an S&P 500 index fund, a real estate investment, and a few individual stocks in industries you know. And once you invest, commit to holding for at least 10 to 15 years. Don't check your portfolio every day. Don't panic sell during crashes. Just hold. The millionaires in this study didn't get rich by being smart or lucky. They got rich by being patient and disciplined. They invested in quality assets, held them for decades, and let compound interest do the work. All right, here's your action plan to invest like a millionaire. Step 1. Simplify your portfolio. If you own 50 different stocks, that's too many. Consolidate into 5 to 10 core holdings. Focus on things you understand. For most people, that means an S&P 500 index fund, maybe 1 or 2 individual stocks you believe in, and possibly some real estate exposure. Step 2. Commit to a long-term holding period. Pick a date 10 or 15 years from now. Write it down. That's when you're allowed to sell. Until then, no matter what the market does, you hold. Crashes, corrections, volatility. You ignore all of it. Step 3. Reduce your bond allocation. If you're under 50 and have 40% in bonds, that's way too much. Move that money into stocks or keep it in cash for opportunities. And step 4. Stop checking your portfolio constantly. The more you look at it, the more likely you are to make emotional decisions. Set it and forget it. That's what millionaires do. The study I analyzed showed me that millionaires aren't doing anything magical. They're not geniuses. They're not insider trading. They're just following 3 simple principles. Keep it simple, hold forever, and ignore bonds. If you do these 3 things consistently for 15 to 20 years, you'll be shocked at how much wealth you build. If this video showed you a completely different way to think about investing, hit that subscribe button. I'm posting videos every week breaking down how the wealthy actually invest, not how they say they invest. Stop investing like you're broke. Start investing like a millionaire. See you in the next one.